London School of Economics and a bachelor's degree with high honors from Swarthmore College. Dr. Warne has appeared on CBS, NBC, CNN, BBC, Canada's CBC, lots of C's in these, and the Business News Network. She has been quoted in such major publications as the Wall Street Journal, the New York Times, the Globe and Mail, and Financial Times, and Forbes and Fortune. Dr. Warne was the energy analyst at Edward Jones prior to assuming her current position as market strategist. She has worked with AT&T and General Motors and was an assistant professor of finance at the John M. Olin School of Business at Washington University in St. Louis, and previously lectured at Yale University and was an economist at the President's Council of Economic Advisors. She is here with us today from St. Louis, and she's escaped the cold, yucky weather there, and I know we're all pleased to hear what she has to say. After she speaks, there will be a short Q&A session.
Thanks very much. I am delighted to be here, not surprisingly since I'm from St. Louis, but also because I spoke here 2 years ago, and in many cases you asked great questions, so I'm looking forward to that. Let me see if I can get this to work. Excellent. All right, so I'm going to start by talking a little bit about the stock market, what's going on in the economy, certainly, and then I'll have a chance to answer questions. But if you just look at what the stock market did all of last year, you can see it pretty much went straight up. How many of you stocks aren't yet back to their long-term trend. We saw stocks are really cheap back in 2008. Up here, I'll just use my finger and point, where we saw them drop off the bottom end of this sort of railroad track chart. And back in 2000, they were really expensive. Today, we think they're attractive. They're not either very cheap or very expensive. They're sort of caught in the middle. But I'll talk some about why it is that we actually think the market is attractive today. Keep in mind, though, that it's likely to be more volatile going forward, and that for the last couple of years, we haven't had as much market volatility, as much of those little wiggles along the way, as we have in the past. So I don't remind you that stocks every year, historically, have tended to drop by 5% or more about 3 or 4 times a year. That's officially called a dip, okay? So you've got to get the terminology right. 3 or 4 times a year, and we just went through one of those. How many of you felt sort of nervous at the end of January when stocks were down by more than 5%? Fair number of you. Well, keep in mind that we're likely to have another 2 to 3 of those this year, and that usually about 1/3 of those turn into corrections or 10% declines. Again, we're now down the middle of the chart here, where we about 10% declines. How many of those do we normally have every year? This is the reading test. I know you can do it. Okay, so how many do we usually have every year? 1, right. And when was the last one? Anybody remember? It was actually October of 2011. Now, for those of you who can do the calendar and the math really fast, that's more than 2 years ago. I've got good news, though, which is we don't have to have 2 or 3 of them this year to catch up. Fortunately, these averages don't work that way. But we should expect a return to just normal, ordinary market volatility, and that means how many Dow points? 1,600, because we're around Dow 16,000. So the reason I'm talking about this is I want you to understand that that typically happens about once a year. It's not a reason to sell investments. It's a reason to, in fact, think about the opportunities to buy, but it's a lot easier to stomach one of those declines if you know that that happens on a regular basis than if you're thinking, oh my gosh, this is new, this is different, and I haven't seen it before. That's part of what we're always trying to do at Edward Jones, which is put things in perspective and make sure you're aware of what it's just normal, what's normal in the marketplace. So we're thinking, yes, we're likely to have a couple more dips, probably a correction this year, probably not a bear market, but we should be ready for one of those too. It won't be as bad as 2008 because we rarely have financial crises, but this is just normal part of investing. If you stay invested through all of these, you get a return that historically was almost 10% per year. We think returns going forward will be a little less than that, but you need to understand what you have to stay invested through in order to get there. Keep in mind that if you buy on those dips, it actually tends to raise your returns a fair amount. If you buy after a 5% dip on the top line there, 6 months later, stocks historically have been almost 10% higher. I can't get the little arrow to work. A year later, 14% higher. And if we do have a correction, again, buying during the downturn tends to add to the long-term returns. In this case, just looking back to 1950, stocks are up 7.1% per year if you stay invested through the whole time. But clearly you can add by taking advantage of the downturns. Now I'm going to shift gears and talk more about the economic outlook, the market outlook, what we see going forward. And we actually see things improving. So keep in mind, those of you who are pessimistic, things are actually getting better. It's just a little hard to tell it right now. The economy is picking up speed. Most economists are forecasting more than 3% growth this year. We're at 2.5%. We're a little shy on that, but that's because every one of the last couple of years something unexpected has happened. But that's still a pickup from the past. We think there's going to be less political uncertainty, not because the issues are resolved, but because the market's not paying a lot of attention, and Washington sort of agreed not to disagree quite so publicly. The global economy is picking up speed. That's good news for the U.S. in terms of exports, in terms of reinforcement of the U.S. growth rate. We've seen fourth quarter earnings come in better than expected. We think earnings should continue to be a positive driver. And we also know that valuations are attractive. And the last thing is sentiment is beginning to shift. While many of you are pessimistic, across the country, people are actually getting a little more optimistic. And that's good news, both for the economy and for the markets. Let's start, though, by taking a look at the quarterly growth rates. You can see in the red over there, that's the Great Recession. Clearly a very severe downturn. The green is what we've experienced so far in terms of the recovery. A little bumpy, average growth rate a little more than 2%. And then the forecast, these are consensus estimates, for pretty smooth growth going forward, all above 2.5%. We're relatively confident on this, partly because if you look at last year's economy, what it turns out is that, think about last year this time. What was everybody worrying about? End of 2011, or I'm sorry, end of 2012 as we went into 2013. What was the big issue? The fiscal cliff, right? People were worried about a huge increase in taxes, I heard somebody say, and then sequestration, the government spending cuts. Well, we didn't go off the fiscal cliff, and we did have at least partial sequestration, and the impact was that government policies on their own, the higher taxes and lower government spending, pulled about 1% off GDP. So the underlying economy was growing at closer to 3%, minus that 1%, that's how we got 2% or so growth last year. This year, there's not the same government drag. So if the government just does nothing, The underlying economy does the same as last year. We've got 3% growth. That's why we're looking at this and saying, yeah, the picture's actually getting brighter. That's good news for the job picture. We've seen 2 months of very slow job growth. And that's been a bit of a disappointment here, just a downtick at the end here. I think a lot of that has to do with the winter weather across the rest of the country. It's really hard to tell right now, and we won't know for another couple of months. But if you look at many of the other indicators, we're seeing things pick up and jobs seem to be lagging. Keep in mind that many companies are now talking about how they're having trouble hiring. And by the way, if you know somebody who's looking for a job and would be a good financial advisor, contact one of my Edward Jones colleagues, because we're hiring here in the broad Houston area. If you look at the unemployment rate, which has gotten a lot of attention because of course Federal Reserve policy is focused on the unemployment rate, you can see that, or at least those of you who can see the gray shadings, you can see that the unemployment rate always declines as the economy picks up. In fact, there's usually about a 6-month lag between economic growth and a decline in the unemployment rate. So what we think is we'll continue to see the unemployment rate decline. But of course, it started higher and is still going more slowly than it has. Just keep in mind it takes a while for the job market to heal. It is healing. It's just healing way too slowly for most people's patience. At the same time, though, while we've got the job market healing, we also know that there are really bright spots across the American economy. And I don't need to tell all of you in the Houston area that part of it is the increased production of oil and natural gas. Left-hand side, I've got U.S. oil production. When I was the energy analyst, what we were seeing was a steady decline in U.S. oil production. Now, of course, due to shale oil, we've got a dramatic increase back to the level of the late 1990s. That, in turn, has meant that what we've got is a dramatic reduction in the amount of crude oil we import, down to the level last seen in the early 1990s. That's good news in terms of overall stability of oil prices. We know West Texas is less than Brent, partly due to bottlenecks across the system. But more importantly, for a longer term outlook, it means that less oil imports means a stronger dollar and, in fact, a smaller current account or trade deficit. Those are both positives that nobody's paying much attention to in terms of the outlook for the U.S. So I think that in many cases, the focus on jobs has really been less of a focus on other more positive indicators. We also know, look at the total net worth of the country, that what we are is back to new record highs. In fact, more than $77 trillion, that's trillion with a T, across the country, up 12% from the peak before the financial crisis. And in our view, that's really positive because it gives consumers more resilience. If we do face additional shocks, if there are other things that turn out to be bad news, what we're in is a better situation in terms of people who are wealthier, feel more confident, are likely to continue to spend, are likely to continue to be able to be resilient through whatever happens next. So in our view, the economy is getting better. It's getting better at a slow rate, and that's why we're looking at a forecast this year that says, yes, growth is picking up, that's positive, but it's not something that really changes the overall outlook dramatically, so a bit of an improvement there. Part of the reason for that improvement is that we're seeing a decline in political uncertainty. This is an index of economic policy uncertainty. The red line across the middle really is just saying, is economic policy uncertainty high or low? You can see historically, it's been low most of the time with occasional spikes. But then after 2008, it became high and has really stayed high for the last few years until the middle of 2013 when it began to fall. It spiked a lot in October of last year, though. Who can think of why it might have spiked in October? Government shutdown, debt ceiling crisis. But did the stock market react to that at all? No. In fact, the stock market didn't even drop 5%. That's part of why we're looking at this and saying, yeah, economic policy uncertainty spiked, but it immediately dropped. And that's good news both for the economy and for markets. It's not because the issues are resolved. It really has to do with the fact that politicians in Washington both are mattering less in terms of the decisions they make and the market is paying less attention. Historically, after economic policy decreases, we see the stock market up on average about 12%. Part of the reason we're seeing less economic policy uncertainty is the improvement in fiscal policy. When you look at the deficits, after 4 years of trillion-dollar deficits, last year the deficit dropped to just above 4% of GDP. This year it's projected to be about 3%. Clearly not nearly the crisis issue that it was back during the downturn. And as a result, it's really faded from being something that politicians are using as a lever. We're hearing bits about it, but it's not resonating as much as it did in the past. And we pretty much have agreement in Washington not to talk quite as much about it. The issue's not dead though, and it will come back, but it'll be a number of years, because when you look at a longer term projection, this one by the Congressional Budget Office, what you see is the deficit declines for the next couple of years, but then begins to grow pretty steadily as the entitlement programs, Social Security, Medicare, Medicaid, grow as baby boomers retire. So this will be back. It is a long-term issue, but it's not a short-term issue. That's why we're saying, no, it's not likely to disrupt markets as much as what we saw over the last couple of years. I want to shift gears now and talk about the next reason we see improvement, which is really synchronized global growth. For the first time in 5 years, when we look out around the world, each of the areas of the world is growing. Japan's coming out of recession. Many European countries are emerging from recession. Emerging markets are still growing more quickly than the rest of the world, although a bit slower than they were. But this is the first time in a number of years where we've got every area of the world growing. And that tends to have positive feedbacks. The U.S. isn't just the driver of global growth. When we look at stocks, however, take a look at what's happened in terms of markets. The U.S. in red on top, the rest of the developed world in blue. Think about the basic rule of investing. You're trying to buy low, right? So if the rest of the world flagged behind, which one is buying low? It's buying international stocks. How many of you called your financial advisor recently and said, I think I need to add to the international portion of my portfolio? Anybody? No, I'm getting lots of head shakes, right? That feeling you've got, it feels risky, it feels uncertain, it doesn't sound like such a good idea, almost always suggests opportunity. So think about dollar cost averaging into international. They've lagged behind, and when we look at valuations, not only do we think the rest of the world's better positioned because many of these countries are emerging from recession, the price-earnings ratio, one measure of valuation, is a little bit less expensive, the dividend yield is higher, and we actually think the earnings growth will be faster outside the U.S. So think about basically walking into international, adding a little bit each month, because that's the area we see the best opportunity. Our investment policy committee added to our international recommendations, suggesting you put up to 35% of your equity portfolio in international equities. And one of the areas I'll caution you about, though, while we like international, we like developed markets, emerging markets still look really risky to us. No more than 5% of your portfolio in international, because we do see risks there, and we don't think investors are getting appropriately compensated for those risks. Part of the reason emerging markets are struggling is that we've actually seen the Federal Reserve change policy. I'm sure you're all familiar with the term tapering, right? A term that we didn't know a couple of years ago. Tapering is simply the Fed having decided, the Federal Reserve having decided that they're going to reduce how much they buy in bonds every month. They were buying $85 billion a month last year. In January, they bought $75 billion, because they're reducing by $10 billion a month. February, they're going to buy $65 billion. If they continue the policy, it'll be 55, right? So they're still buying bonds, they're just buying less each month. That's why it gets referred to as tapering. They'll be finished buying bonds sometime in the fall, so they'll be out of the market for bonds. As a result, we think long-term interest rates are likely to continue to rise because the Fed won't be in buying bonds, so rates are likely to go up. But they've also said, what are they going to do with short-term rates? Where are short-term rates? They're near zero right now, right? For those of you who invested in a CD anytime recently, really love that rate you're getting? Yeah, not so much. Near zero, likely to stay near zero because the Fed has said they're going to keep short-term rates near zero at least until 2015 because they want to continue to provide support for the economy. So long-term rates are rising, short-term rates are staying low. That says to us there's more risk in long-term bonds. So we reduced our allocation to long-term bonds to no more than 15 to 25% of your fixed income portfolio. We think laddering bonds is the most important thing, making sure you have some short-term, some intermediate term, some long-term bonds. But what we want is less in long-term bonds in order to reduce the risk as interest rates rise. Let's take a look at, one of the things to keep in mind though is long-term rates are not rising because of higher inflation. Usually when rates rise, that's the first place that we look is rates are higher, that must be inflation. But actually inflation expectations, which is sort of the leading indicator for inflation, still says no, inflation's expectations are running just above 2%. Our view is inflation's likely to move back to around 3% long term, but right now, the Fed, if anything, is still worried about deflation, not inflation, because we keep seeing prices fall in many areas. So there's not much in terms of an upward push to inflation. But let's take a look at history, because we've had times of falling long-term rates and times of rising long-term rates. And what we can see is all of us, as I look around the world, have pretty much lived in a time where long-term interest rates have been declining. We think that's normal. But if you go back to the period of time from 1962 to 1981, long-term interest rates pretty steadily rose. And the reason I want to differentiate these is during the more recent period, from 82 through 2013, long-term returns for bonds, returns on long-term bonds were a little more than 10% per year. In contrast, they were only 3% per year back in that earlier time period. So many people just sort of think it's normal that I'll get great returns on my bonds with a lot less risk. We think going forward, returns on bonds are going to be okay, but they're going to be a lot lower than many people are expecting. So that's why we're saying own some long-term bonds, but keep in mind the returns are likely to be a lot less than anything you see in terms of historical averages. We began to see that last year. The red line is long-term interest rates. They rose about a percentage point. The value of bonds on your statements declined. And we'll see that happen again as long as we think long-term interest rates are likely to continue to rise. That's why we think what's so important in this environment is to make sure that all of our clients, all of the people we talk to, have diversified portfolios that are a mix of stocks and bonds. This is an example. It's a portfolio of 35% fixed income, 65% equities, so 65% stocks, rebalanced every year back to that target. And the good news is if you owned this portfolio historically, even during the 2008 drop in the market, you've never had a 5-year period where the return was less than 1% per year. So for many people, the big worry in this environment where bonds don't look so attractive and stocks obviously are really volatile, and many of you said you were pessimistic, the important thing is to have a mix of stocks and bonds so that you're not all in stocks, all in bonds, or trying to make guesses along the way. I'm going to shift now and talk a little bit about the stock market and why we see it as attractive in this environment where we see the economy improving. Valuations are reasonable. They're not cheap, they're not expensive. Price earnings ratio for the S&P 500 is about 15. That's in line with its historical average. And in our view, that's still an attractive time to buy stocks. Historically, stocks have returned over the next year about 7% when the price earnings ratio has been in line with the historical average. In addition, and probably as important, we think corporate earnings are going to continue to rise. Here we can see the pattern over time. Sometimes earnings go up, sometimes they go down, but the consensus forecasts are for earnings to go up. We think they'll be up mid-single digits this year. That's a little faster than 2013, where earnings were up about 5%. Fourth quarter earnings, which we're just finishing, were up 9.5% year over year. That's a bit faster than we think we'll see for the entire year, but it gives you an idea that corporate America is still generating profits They're still doing it even in an environment of slow demand, of slow economic growth, and we think they'll be able to continue to do that. So we think stocks are attractive, and there's one more reason to feel a little more optimistic than many of you seem to. And that's if we look at mutual fund flows into equity funds, into stock funds. Over the last 5 years, what have stocks done? They've gone up, right? Okay. What have investors done? They've actually sold stocks. So they haven't been buying over that 5-year time period. They've actually been selling. Net equity fund flows have been negative. Circled here, for those of you near the front, since I'm sure at the back it's hard to see, what we finally saw was after 5 years of very solid markets where the stock market's more than doubled, what have we seen? We've finally seen investors get a little more comfortable and start to put money into stocks. Historically, that trickle turns into a flood. So we think that even when we see the pullbacks we're likely to see in the market this year, what are we going to see investors doing? Well, they've just now gotten willing to put money into stocks. We think they're going to put more money into stocks. And then what we'll see is these numbers get more positive right at a time where the market gets a little more volatile. That gives us a little bit of comfort that even during pullbacks, stocks are likely to continue to rise. So I've talked about we like stocks, but what kinds of stocks? We'll take a look at the fact that the highest yielding stocks in the S&P 500, the highest yielding, back over 43 years, back to 1972, have managed to lose money during that entire time. It's really hard to lose money in the stock market over 40 years, but the highest yielding stocks have done that. Negative 1.8% per year. Stock market over this entire time, up about 7.6%, that's the S&P 500. But what's done the best? Companies that pay dividends, and more importantly, companies that grow their dividends. That's why at Edward Jones we're always talking so much about focusing on dividend growth, not on high yield. And we think you should do that in your portfolio as well. 10.1% per year over that 43 years, you looked at dividend growers and companies that just started paying dividends. So keep in mind that we're not talking about all stocks. What we're focused on are companies that in fact provide rising income. If you look at the handout that we put on your table, you can see that people have different reasons for investing. Some people are saving for retirement, some people are living in retirement. We actually think stocks that pay dividends and grow those dividends regularly are likely to provide a solution for many types of investors because they give you rising income if you're in retirement, and if you're saving for retirement, they give you money to reinvest every year. What else do we think is attractive? Well, right now we're seeing lower correlations across stocks. That means that companies are trading more on their fundamentals, and we see 3 types of stocks that we think are really attractive. First, those that are out of favor, that have been left behind. So far this year, we've seen companies that did well last year lag behind, and many of them that did poorly last year come from behind. So we think stocks that are out of favor are a place to look. We think that companies that are changing their business, have a catalyst, are likely to offer an opportunity because there's something new, something that gives them faster growth. And there's a third area. We think companies that have been doing well, some of them have the ability to continue to do well. So take a look at those. If you want to talk to the Edward Jones financial advisor at your table, they have a list of stocks or mutual funds that can invest according to each of those 3 styles. So where are we? We've taken a look at the economy. We think it's getting better. We actually think there's fewer obstacles to economic growth, fewer things standing in the way. We think that there's less political uncertainty. The rest of the world's beginning to grow. Earnings are likely to continue to rise a little faster than what they've been doing. Investor sentiment is shifting. I know we didn't see it so much in this room, but overall, across the country, people are feeling a little bit more optimistic and valuations are reasonable. So to close, before I take a couple of questions, let me just pull all this together. We do think this is a time where we're seeing slightly better economic and earnings growth. That's positive. That's positive for the market. We see signs of a synchronized global rebound as the rest of the developed world picks up. And while emerging market growth isn't quite as strong as it was, we think that's positive as well. On the interest rate side, we do think long-term interest rates are likely to rise a bit more, but short-term rates stay low until 2015, and then 2015 or 2016, the Fed will start to raise them as well. So a difference, basically a shift in the interest rate environment. We see inflation is staying low. We don't see a lot of reasons for higher inflation, especially while the Fed continues to be worried about deflation. But the last part is the stocks are reasonably valued and sentiment is starting to shift. That's actually a positive time for the equity market. So let me open up and take just a couple of questions before I pass it on to my colleague who will talk on the more local area. So questions? Yes, sir.
Could you comment on the economic downturn in China and how you think it will affect us, the American economy?
Sure. The economic downturn in China and how it will affect us in the U.S. China's economy has really been boosted by government spending over the last couple of years. Now, in many cases, as they tried to put more money into the economy, they did it through bank loans. Those loans are now, in many cases, going bad. Sound familiar at all? And so people are worrying about what happens when many of the loans in China begin to falter. Are they going to be able to file bankruptcy? What happens? And the growth rate has slowed from 3 decades of more than 10% per year down to a little above 7.5% right now and could be slowing further. So we're looking at all this and saying, clearly the slowdown in China is having a major effect around the world. The first impact, which is affecting us somewhat, is the fact that there's less demand for raw materials. That's affecting many of the emerging markets countries. That's part of why their stocks are down so much and why, in many cases, they're actually struggling far more than we do. But what does lower demand for commodities mean? It also means that commodity prices have dropped, and as a result, the inputs, the many things we use here, are lower in price. That's part of why the Fed's continuing to say we keep seeing lower prices. So the first impact of the Chinese slowdown is we're paying less for anything that's tied to commodity prices. The second impact, though, is through the uncertainty and the instability in emerging markets. In many cases, those countries were tied to stronger demand from China, and if it continues to slow, that could have less demand for U.S. goods as well. And some of our exports, some of our companies' earnings are tied to emerging markets, although actually it's a pretty small percentage. But it's a worry there, it's a risk that we could see some instability there. Tied to that is the fact that many of those countries are now raising interest rates, slowing their own economic growth, because they're facing a difficult situation where their current account deficit is no longer getting the money needed to finance it from the rest of the world. Investment flows have come back to the U.S., are going less into emerging markets. So there's sort of a tie there. What do I think the impact will be? As long as China's able to keep its growth rate above 7% or so, very little. It'll be essentially a negative backdrop to what I'm spinning as, or talking about as more of a positive story for global growth. I think if Europe picks up more strongly than anyone's expecting, it's actually really good news for China because Europe is China's main customer. If European growth is stronger, then what we'll see is less worry about China. But what happens if China does slow mo? There's the possibility of political instability. There's a possibility of more tension in the Pacific as China focuses more outward, trying to basically rally the population around an external enemy rather than economic growth, which has been the driver for the last 30 plus years. So I see it as potentially having bigger risks, but I think most of those are very unlikely at this stage. So I'd say right now the main impact is China's slower growth has brought down commodity prices. I think China will be able to stabilize its growth at around 7%, and that'll mean it's a lower growth Asia world, lower growth in developing markets. That's part of why I'm concerned about keeping emerging markets a small piece of portfolios, but it'll have very little impact back on the U.S. Another couple of questions. Others? Yes.
Could you comment on the Fed tapering policy, the impact on mortgage markets, the impact on housing, corporate borrowing, durable goods?
Sure. So the question I think everybody heard is the Fed tapering, what's the impact on mortgage markets, on borrowing, basically more broadly on what's going on? Well, clearly, as the Fed tapers, it's buying less in bonds. So less, what you're likely to see is, as a result, instead of having one more buyer in the marketplace, we think long-term rates are going up. The obvious impact on the mortgage market is more of the same of what we've seen. Mortgage rates are up about 1% from the time at which Ben Bernanke back in May, early June, started talking about beginning the policy of tapering. We see another % or so rise in mortgages over the next year or so in mortgage rates. Now, keep in mind that mortgage rates, as probably many of you know, because I know that many of you are in real estate, are still very low compared to history, but they've gone up a lot over the last year. A full percentage point is a huge increase. So what impact does that have on the housing market? Probably less than what you might think. And it's largely because the rates are still low compared to history. Housing affordability across the country is still quite low or quite high, depending on how you talk about it. In others, houses are still quite affordable. And what we're seeing is, with the no longer having so many foreclosed homes coming onto the market, what we're actually seeing is finally housing demand, housing formations translating into actually new construction starts. It's been more on apartments than it has single family houses so far, but we're likely to see that continue with house prices tapering off from what they've seen over the last year or two. Last year, house prices across the country were up about 13% year over year. We don't see that continuing, but we do see house prices continuing to rise, just at a much slower pace as the Fed's policy basically dampens the demand and the affordability of housing, but it doesn't entirely undo it. In terms of corporate borrowing and things like that, yes, again, higher rates, but a slowdown in terms of, but not back to historical high levels. And I think what we're likely actually to see is companies doing more borrowing because of the fact, not that the rate looks better, but the rate hasn't been an issue for a number of years. It's companies haven't been willing to make investments in new plant and equipment because they haven't felt confident about demand. If the confidence shifts, I think that overwhelms the rise in rates, and we actually do expect an increase in business and equipment spending, basically business investment this year, as well as residential investment. So we're seeing a positive on both sides there. So one last question, and then I'll turn it over. Any other questions? Yes, sir.
Will Bernanke's successor, will she exercise her own style, or is she just going to stay the course?
Okay. Bernanke's successor, Janet Yellen, is she going to exercise her own style, or is she just going to stay the course? I think that's a great question. Short term, she's just going to stay the course. Remember, she was vice chair of the Fed, and so she was part of all the policy decisions that Ben Bernanke, was the front person for, so to speak. So no surprise, there couldn't have been a more likely smooth transition to have somebody who is literally the vice chair take over. Think of that in terms of if you're thinking about corporate succession or succession in this group, the person who's second in command taking over from the first, you don't expect any change. I think the first time we'll see any indication of a different policy from Janet Yellen, something that might be a transition, will be a couple of years from now when the Fed finally starts to raise short-term interest rates. That's something that was really left out in, very much in the future, 2015, maybe 2016. It was tied to the unemployment rate falling to 6.5%. We're at 6.6%. So clearly it's going to be tied to something else because nobody thinks the economy is strong enough to raise short-term rates. So that's where you'll begin to see, does she delay it longer than what people think should be the case? Do we see inflation rise more? If inflation doesn't rise, we're likely to see the Fed keep rates low for a much longer period than anybody's expecting right now. Because I think, if anything, she's going to err on the side of waiting for higher inflation rather than trying to anticipate it, trying to get the economy stronger so that people feel better. So thanks very much. I really appreciate your time, and I'm delighted to be here.
We want to thank Dr. Warne, and we hope that she'll accept this on behalf of the Chamber for her efforts here. A lot of information, very short period of time, and we're so glad that we don't have a quiz. Next, we have Pat Jankowski. Pat Jankowski is a regional economist and vice president of research at the Greater Houston Partners. He oversees the research department and provides information gathering, data analysis, database management, economic forecasting, and mapping functions for the partnership's 5 divisions. Mr. Jankowski is a member of the Texas Economic and Demographic Association, the National Association for Business Economists, and Commercial Real Estate Research Forum. Currently, he is the president of the Houston Economics Club, and he serves on the board of the Washington-based Council for Community and Economic Research. He received his economics degree from the University of Texas at Austin. Sorry, just can't help that. Mr. Jankowski has worked for the Greater Houston Partnership and its predecessor, the Houston Chamber of Commerce, for 30 years. Back again, please help me welcome Pat Jankowski.
Thank you very much for having me here again, and it's great to actually see a coworker, someone who I worked with 30 years ago in the audience. And so, and, you can tell me afterwards how I'm doing. So, let's go ahead and get started. The title of mine is The New Normal for Houston, because that's actually what we're getting to, is the new normal for Houston. But before we get started, I want to let you know that I do tweet now. If you'd like to follow me on Twitter, I will not tweet what I'm having for breakfast or where I'm looking for a movie. But I do tweet about what's happening in the economy. We're getting ready to tweet the housing numbers were just released at noon today by the Houston Association of Realtors. In January, we sold around 4,700 homes, another record for January. That's the sort of information you get on the tweet. And I blog about the economy as well. There are some cards that look like the sitting as you go out, if you want to know how to contact me on Twitter or with my blog. So let's get started. Start with the big picture. Well, I like transition slides, and so every slide that you see up here that's a transition slide is something for the Museum of Fine Arts. We talk about the crown jewels that we have, all the things we're very proud of, whether it's the airport, whether it's the Texas Medical Center, whether it's NASA. We should also be very proud of our art community that we have here in the region. And so every picture you see there, if you go to the Museum of Fine Arts, you'll see it hanging on the wall there. So let's get started. This is one of my favorite graphs. Of all the graphs that I will put up, every graph I show, no matter what audience I speak to, I include this graph because it shows just what's happened with employment in the Houston region since the bottom of the recession. For us, the bottom of the recession was in January 2010, and since then we have created 362,000 jobs. We've created more than 2 jobs for every 1 job that was lost in the recession. This is what we've seen happen over the last 4 years. 2010 was the year we came out of the recession. We created approximately 47,000 jobs. Growth in jobs continued. We had this incredible year, 2012, one of the fastest years for job growth on record. We created over 105,000 jobs. And the data that just came out a few weeks ago showed that we created 82,000 jobs in Houston last year. We've created jobs in every sector but 2. For those of you at the back where it's hard to read, the largest bar on the far side is business services. That's going to be heavily weighted towards engineering here. It'll also include accounting, law, management services. It'll include things like computer design, software, and so forth. And as you read across, there are only 2 sectors which did not create jobs last year. One is financial services, and the other is the other services sector. The thing is, the data is going to be revised on March 7th because we go back and look at another set of data. I suspect both of those numbers will be revised when the March 7th benchmark revisions come out, and we'll see positive growth in every sector. If you want to look at the unemployment rate, the green line is the U.S., the blue and the red lines are Texas and Houston. You can see that Houston's and Texas unemployment rate never got quite as bad as the U.S., and you can see that we are still improving steadily, even faster than the U.S. One of the differences between the unemployment rate in Houston and Texas and the unemployment rate for the U.S., there's a debate going on that a lot of the decline in the unemployment rate in the U.S. is people leaving the labor force. In Houston and Texas, the decline in the unemployment rate is due to more people working. The labor force has continued to grow, and the unemployment rate has continued to decline, which is a very healthy sign. So, transition slide, Houston versus the competition. I'm in the economic development business. One of the things we do is we go out and try to recruit corporations to come to Houston. Or we have companies which we're worried about leaving Houston, and we try to convince them to stay. And when we talk to these other companies, these companies in other metropolitan areas, we talk to them about the health of Houston's economy. So you want to be in a metropolitan area that is growing and that's thriving, don't you? And they say yes. If you look at this, this is the percent of jobs that the Houston region has recovered since the bottom of the recession. I think I've had this one up last year, and how we've done compared to the top 10 metropolitan areas in the United States. This is metropolitan areas 1 through 10 ranked by population. That 362,000 job number that I had up earlier, that actually equates to 268% of the jobs that we recoup. We recoup 268% of what we lost in the recession. So we got Houston, Dallas, Washington, Boston, New York. That dashed line that goes down the middle, if a metropolitan area has not passed that dashed line, that means it's still not fully recovered from the recession. That means its employment level is still lower than it was at the time it entered the recession. So you can see Houston and Dallas, Washington, employment's at an all-time high, but you can see Atlanta, Miami, Chicago, LA, and Philadelphia are still struggling. This is metropolitan areas 1 through 10 ranked by population. This is like your top tier. Go to your second tier metros, it's even stronger. So Houston compared to Baltimore, a suburb of Washington, and Minneapolis, Seattle's just back to where it was. But you look at San Francisco, San Diego, Tampa, Phoenix, Riverside, all those areas, still employment has not got back to where it was 5 years ago, back when the recession started. So we are also growing at one of the fastest rates. This is the 20 largest metropolitan areas. It gives you some idea of the rate at which they're creating jobs. This is job growth in 2013. You can see Houston added jobs, we added jobs at a 3% annual rate. Our job base is 3% more people working now than we did. That's what that 82,000 equates to. See, Tampa's at 3%, but as you read it across, you get Seattle, employment grades drew 2.6, Phoenix 2.5. This is Philadelphia over here at 6.4. So you can see not only are we further along in the recovery, we're still the fastest growing of the major metropolitan areas. Now, there are smaller metropolitan areas that are growing faster, especially places like Midland and Odessa. But if you look at who we consider to be our peers, the major metropolitan areas, we are tied with Tampa to have the fastest growing employment base. So let's look at just a few key sectors. It's a Thomas Hart Benton photo of painting. Look at what's happened with oil prices. Oil prices since 2010, the year we came out of the recession, have not fallen below, on an average annual basis, below $70. And they've actually stayed above $90 a barrel for the last 3 years. And that's very important because a lot of the recovery, a lot of the prosperity we're currently enjoying as a result of what's going on in the Eagle Ford Shale and the Permian and other places like that, where they're using hydraulic fracking and horizontal drilling and these other kind of exotic methods to recover oil. If the price of oil falls below $70 a barrel, those methods are no longer economically viable because they're very expensive. But as you can see, they've remained above $90 a barrel for the last 3 years. And if you look at the projections for the Energy Information Administration, they're projected it'll remain above $90 a barrel for some time into the future. Look at home sales. Last year we sold 88,000 homes in the Houston region. This is for the 10-county region. You see the bubble, and that is a bubble. If you look at the prior peak, that prior peak was a result of subprime financing. We're lending money to people to buy homes who couldn't afford to buy homes. We're building homes that we should not have built. This growth right here is due to job growth and population growth and income growth. So while that was unhealthy, this is healthy right here. It's something that's being sustained by a healthier economy. Let's look at auto sales. You can see the previous peak. You can see we're almost back to the peak. It'll be a while before we get back to the previous peak. For one thing, they're making automobiles a lot better now than they used to. If you remember me, I remember my parents buy a car in the 70s, and they were lucky to get 70 or 80,000 miles out of it. It wasn't because they had a teenage driver. It was just the way they built cars now. I've got a pickup truck in the parking lot that's got 170,000 miles on it, and I'm hoping I'm going to get another 50,000 out of it because they're just built so much better. But the other thing which is important about this to note is Houston does not have a local consumer confidence index. You hear there's a Michigan consumer confidence index, you hear Gallup does polls, but this is a really good surrogate for consumer confidence in Houston because most rational consumers won't go out and sign a note for 5, 6, or 7 years for an automobile if they don't feel that they're going to be able to make those notes into the future. And so what this tells me, there are a whole lot of people out here who feel very confident about their financial situation and about their jobs that they're willing to go ahead and sign one of those notes and take on one of those long-term loans. And this is the Purchasing Managers Index. You may also hear it as a PMI. This is a survey which is done by the Institute for Supply Management, where they go out and talk to about 80 purchasing managers in the region and ask them questions like, are your sales increasing or are your sales declining? Are your inventories building or inventories declining? Are you hiring or are you laying off? What are you paying for intermediate goods? What are you paying for finished goods? They crunch all these numbers together and you come up with an index, and whenever the index is above 50, that's a sign that the purchasing managers are expecting the economy to continue to expand at least the next 3 to 4 months down the road. It doesn't mean that it's going to expand. It's not going to expand 3 to 4 months. It's just this is as far as it reads forward. Just think about it. The purchasing manager is the one on the front line who needs to make sure there's enough stuff in the shop so you continue to build and continue to deliver your services. If you look at the PMI, it's been above 50 for the last 4.5 years. And we're looking, this tells us at least through the middle of the year, we're going to have a strong economy. It doesn't mean that it's not going to be strong after the middle of the year. It just says, what this is telling us, we're looking for some good times for the next 3 to 4 months. So, where is the economy headed? Where is Houston's economy? We had great insight of what's happening with the U.S. economy. Give you some insight as to what we see happening with Houston's economy. Once again, this is one of my favorite charts. It's not only favorite because of what it says about how strong the economy is. It's about 362,000 jobs created since the bottom of the recession. I also like it because it's like the classic business cycle graph. This should be in chapter 1 of any macroeconomics book that you pick up, where you can see how the economy goes, where you peak, you have a recession, a trough, and then the recovery. And I like it because if you look at this business cycle graph, it looks a lot like that. Yeah, it's a little jagged, but you can still see the peak, the trough, and the expansion. So it looks like the business cycle. So we're right there. We're right there. We've gotten back everything. We're above our previous peak. We're in our expansion mode. So the question is, when does the line start to bend? When does this little piece right here start to look like that piece there? So when does the line start to bend? Well, I need to let you, it already has. It already has started to bend. Now, I'm not saying that Houston's going into recession. I'm simply saying we're going to start seeing slower growth than we've experienced the last 4 years. And that's not necessarily a bad thing, especially if you drive Houston's freeways. So, this is that chart that I showed you earlier where I compared the growth rates, and I had all 20 metropolitan areas, and I showed you their annual employment growth rate. If you take this and you put, what was the annual growth rate back in May of 2012? We were adding jobs at the rate of 3.8%. And then, look at September 2012, we're adding jobs at the rate of 4.4%. If you look at, in February, we're adding jobs at the rate of 4.5%. It just shows you how fast the economy is growing. But if you simply add a trend line to that, it's not real complicated. You just go into the Microsoft and say, give me a trend line. It looks like that, and that shows you where the trend is. It shows that we still have employment growth, but the employment growth is slowing. Remember, I'm saying it's slowing, and we're at 3.0%, but you need to remember, we're still the fastest growing of the major metropolitan areas. We've been beating the pants off everybody. We're so far ahead of everybody now, it's going to be a while for them to catch up. This is not necessarily bad that it's slowing. As I say, that's a Frederick Remington. It's called the watering hole. There's no need to panic. There's no need to panic because Houston's slowing, because what we're doing is, my theme, that bend is not bad news. It suggests that Houston is finally returning to normal. After what we've experienced the last 5 or 6 years, we're finally getting back to normal. This is my economic pendulum. Maybe I should have a clock up there. If you look at what's happened since December of 2008, we had a period where we were losing jobs at an annual rate of 111,000. And we are adding jobs at the rate of 120,000 a year. Think of that swing from 120 to 120. Oil prices dropped to, on a monthly average basis, around $30. They got up to about 114. Natural gas prices fell below $2 an MCF, and they got up to 7.5 an MCF. Rig count was below 1,000, then it was above 2,000. So you can see these were the troughs when things were at their worst. You can look at this side, the peak when they were actually at their best. That's a classic kind of economics talk, trough and peak. We could relabel that and simply say the left side's not normal. We knew that wasn't normal for Houston. And the right side was not sustainable. We can't sustain job growth at the rate of 100 or 120,000 a year. We just can't, and it's not desirable. So if the left is not normal and the right's not sustainable, let me talk a little bit about what's causing the bend and where we're going to be. Everybody recognize Andy Warhol? I had to find something for bend there, and I thought Andy Warhol was appropriate. So, okay, the rig count, North American rig count. We had this great recovery here, but the rig count has actually been flat for the last year, 18 months. And the flattening of the rig count has implications for oilfield services, but also has implications for manufacturing in town. What we're seeing is, are there any oilmen in here? Anybody works for Exxon? Anybody knows about pad drilling? I mean, this is something which has changed. It's very dramatic in the industry. It used to be that if you were going to drill for oil in a reservoir and you needed to sink 32 wells, you'd sink 32 wells, and you'd end up putting the rig up, or 32 rigs up, and you drill 32 wells, 32 holes. Now with directional drilling, you can set up one rig and have it go down and have it go up in 32 different directions inside the play. Not only that, is with this directional drilling, they have something called, you have mobile rigs, I mean literally mobile rigs. You can go onto YouTube and Google it and find one where you drill a well, they're finished with the well, they flip a switch, and the rig literally gets up and walks over another 100 meters, sets down, and starts drilling again in another direction in a matter of a day. So think about, here you need 32 crews, 32 wells, 32 rigs. You need one crew, one well. What's happening is what you see happen with a lot of industry. We're getting very good at what we do. We're embracing more technology. We're becoming much more efficient. People talk about the efficiency of the electronics industry. Think of the efficiency of the oil and gas industry to be able to do this. If you think about it, the flat rig count, in Texas alone, we drilled 8,000 more wells last year with fewer rigs. And we increased our production by over, 100 million barrels. With fewer rigs and fewer crews, it's a matter of technology, it's a matter of efficiency. And that's what we're starting to see impact oilfield services and oilfield equipment manufacturing. If you want to look at that number that I talked to you about, I like to show the rate of employment growth which has been occurring over the last 12 months for the industry, for the economy as a whole. This is just two sectors, exploration and production on oilfield services. And you can see exploration production was growing at 3.5%. At its peak, we were adding jobs at an 11% annual rate, almost an 11% annual rate. You can look at oilfield services, at its peak, we're adding jobs at almost a 20% annual rate. Just incredible growth. But you look at the last two data points, exploration production has dropped down to 5.3, and oilfield services less than 1%. That's practically stall speed. And it's so important because this is a very big part of Houston's economic base. So that same concept, annual growth rate. At what rate is the economy growing? What rate is employment growing? This is employment in our base. The energy, manufacturing, and engineering. Things that we export outside the region. And your base has to grow for your secondary sectors to grow. Because these are drawing money into the region, and this money gets spent to the region, and it gets spent at the grocery store, it gets spent in the daycare, it gets spent at the movie center, it gets spent at gallery furniture. So, but you can see the peak and the trough files of the nice business cycle, but you can see it starting to turn down. This is the other sectors. This is everything else. This is your secondary sector. And you can see this follows somewhat a similar pattern. You lay the two off each other, and you can see once the base starts to turn, the secondary sectors start to turn. So it's showing signs that we are starting to see a slowdown. It's still very strong. Any other major metropolitan area would kill to have our growth. And that's kind of the irony of it. Normal for Houston would be stellar for everyone else. But we're getting back to normal growth. Let me show you another one. This is foreign trade. You can look at here. The top is imports. The bottom is exports. The imports have declined because we're importing a lot less oil. Obviously because we're producing a lot more. But we're looking at a bit of a flattening in exports for Houston if you just look at exports alone. So you can see the incredible growth we've had since 2009, which was our recession year. And you can look at we've added almost $54 billion in exports since our recession year. Phenomenal. But you see it's starting to flatten out. We're still going to have growth, but we're not going to have accelerating growth. We're going to have normal growth. One thing I am taking part to is that we are starting to see the U.S. economy pick up growth, as Dr. Warne was saying. This recession, we came out of the recession because of what happened with oil and gas and because of our exports. And as the U.S. economy starts to pick up, it's going to pick up the slack that oil and gas is letting us is causing. So, but I need to emphasize, there are no storm clouds on the horizon. There is no need to panic because my first slide, remember, we're returning to normal because what we've had the last few years has not been normal. So the forecast, my organization's forecast is for us to create 69,800 jobs this year. Still a very strong performance. We're going to see job creation in every sector, and this 2.5% growth is still above the historic trend. Houston, on average, adds job growth about 2.2% annually. So we're still above the long-term historic trend. Now, this is just very simple math here. If you take annual job creation over the last 22 years, divide it by 22, create 44,300 jobs. If you take out the weak years, years in which we lost jobs, or years in which we created less than 10,000 jobs, we averaged about 63,800 jobs, and our forecast calls for 69,800. So we're still going to be growing above the long-term average, but we're not going to be growing as fast as we grew last year. So jobs created, professional services, trade, transportation, utilities, education, and health are going to be driving job growth. When we say trade, trade is retail trade and wholesale trade. It's not foreign trade. It's wholesale and retail. But you can see we're forecasting job growth in every sector. If we hit our forecast, next time I put this slide up, it's going to say 407,000 jobs created since the bottom of the recession. Just phenomenal. If all we do is normal, if all we do is average, if we simply go back to what we do without a recession, with a normal year, we're going to go over 400,000. We'll have over 400,000 jobs created since January 2010. So what might a normal year look like? If we go back to normal, if Houston simply goes back and Houston Metropolitan to growing at a normal pace, we're still going to be adding about 125,000 residents a year. Now you need to know that that's not all 125,000 people moving here. Every year we have about 90,000 babies being born. We have about 30,000 deaths. So you're going to get 60,000 increase in population regardless, just through the natural increase. We're having, the last few years, we've been tracking about 65,000 people a year moving here. That includes job holders, that includes families and children and so forth. Employment, if we simply say, let's round it off, normal year might look like about 65,000 jobs. Housing starts about 30,000 single-family homes a year. 12,000 multifamily homes, I think that number's low. I think it should probably be about 18,000. I need to update my slide. Foreign trade, a normal year, we'll probably have about $250 billion in foreign trade pass through the region. And the airport nearby will hand this, and Hobby will handle probably about 50 million passengers a year in a normal year. Well, it's interesting. I give this presentation to some real estate groups, and people go, normal? Oh, I don't want normal. I like what I've had. Well, normal's good. If you put it in perspective, if all we have is normal, if all we do is we grow at the long-term average rate, we revert to the mean, and simply grow at a normal rate for Houston. That means 5 years from now, you see, 5 years from now, there'll be 625,000 more people living here. Even if no one moved here and we simply went to the natural birth rate, we'd have 300,000 more people living here. We'd have 325,000 additional jobs if all we do is create jobs at the rate of 65,000 a year. We'll build 150,000 new single-family homes if all we do is build them at the rate of 30,000 a year. 60,000 fresh apartment units. 1.2 trillion in foreign trade is going to pass through this region over the next 5 years. And 250 million air passengers pass through this region over the next 5 years. So, from a forecaster's perspective, normal looks pretty good to me. I hope it looks good to you guys too. So, that's it. Thank you very much. I'll entertain some questions. And any question about the national economy, I'm going to defer to my colleague. My expertise is the regional economy. Yes, in the back.
Question Do you have any of your data broken out by geographic region across the greater Houston area in terms of where this growth in jobs is going in terms of maybe more specifically the east and northeast part of Houston that impacts all of us?
We can, as far as where the jobs are, the way the data is reported by the Bureau of Labor Statistics and the Texas Workforce Commission, they will report it by a metropolitan area. There are ways you can go back and pull it out by a county area, but as far as locating it to a specific address or a specific census tract, that's doable if you want to go and dig down and pull out census tracts and so forth like that, but it's not very easily, so we don't do it. My organization represents the region as a whole. We want to see all 10 counties prosper. And as there are people who live in Kingwood who work downtown, and there are people who work downtown who live in Kingwood or who I happen to know are looking at a home in Kingwood, it benefits growth anywhere in the region, benefits us all as a whole. General rule of thumb, though, we're going to still see growth going out the Katy area. We're going to see growth going up 45 between the Woodlands and the airport because of what's going on with Exxon. Areas that we see strong growth that will be occurring. That crescent, if you look at as a clock, and you probably go from about with the airport being 12 o'clock, you'd probably go from about 4 o'clock to 12 o'clock is where you're going to see most of the growth. Other questions? I answered everything for everybody. Danielle, how'd I do?
Well, other than the fact that I must have only been 10 years old when we worked together.
Yeah, we worked together doing public relations a long time ago. So thank you very much, everybody.
Again,